Hello and welcome to Rajya Sabha Television. You're watching The Big Picture with me, Frank Pereira. India's foreign exchange reserves crossed the $400 billion mark for the first time ever, strengthening hopes that the country will be able to withstand an expected reduction in stimulus by the US Central Bank later in the year. The country's forex reserves surged by $2.6 billion to reach an all-time high of $400.72 billion in the week ended September 8, 2017. The surge in India's forex reserves is likely to help the rupee withstand any volatility that may be seen on exodus of foreign funds from India's debt and equity markets. Foreign institutional investors have pumped in more than 1 lakh crore rupees into the Indian debt and equity market in the last 12 months. On this edition of The Big Picture, we will analyze how can India leverage its foreign wealth. Joining me on the program today are Renu Kohli, former staff member, RBI and International Monetary Fund; Ajay Dua, former Secretary, Ministry of Commerce and Industry; A.K. Bhattacharya, Editorial Director of the Business Standard; and S.P. Sharma, Chief Economist, PhD, Chamber of Commerce and Industry. Thank you to all my guests for joining me on this edition of The Big Picture. Renu Kohli, I'd like to begin with you, of course. How do we stand to benefit from the surge in forex reserves?
The benefit is, advantage is it's an insurance against any kind of external shock which can impact the rupee, because India runs a current account deficit. It exports far less than it imports, and moreover the current account deficit is financed by capital flows which are mostly fickle in nature. Fickle meaning it's described as hot money and it can reverse any time. There is a loss of confidence or there is an increase in risk aversion in the West, etc. Now, having said that, the benefits, it's important to note that these reserves are really borrowed because they are accumulated from surpluses on the capital account. So therefore, to the extent that these are the claims, the foreigners' claims upon India rise, there is a cost incurred by holding these reserves. So, you know, the cost is not insubstantial, and roughly it's the difference in the yields that the Reserve Bank pays on the domestic assets vis-a-vis what it earns on its foreign assets, and that is quite substantial. So, you know, one is paying, the country is paying to hold such high volumes of reserves, unlike reserves from, say, in China, which has about 3 trillion. China is earned these surpluses, these current account surpluses. They come from higher exports vis-a-vis lower imports, and therefore, rightfully, they belong to China. And unlike that, India is borrowing it and accumulating it mostly from portfolio capital inflows, and therefore there is a cost that it incurs.
Sure. You know, Mr. Dua, how can we leverage this forex wealth that we have at this point in time? We're falling in the top 8 in the world at the moment. How can we leverage it?
I think we're doing it fairly well. Though it's taken us a decade, to put the record straight, to move from $300 billion reserve to a $400 billion. And as has been pointed out, the increase in the reserves since January this year are largely on account of the portfolio investment. About $6 billion in equity, which is hot money which can be withdrawn fairly quickly, and about $20 billion in increase in investment in Indian debt market. The confidence, this higher degree of import coverage. Now 13 months of import being covered instead of 7 months earlier, 10 years ago, gives confidence in India, gives confidence in the Indian currency. The rupee at 64, which it had touched, you know, to a dollar on the 7th of September, was a 6% increase over what we had seen in January this year. So to that extent, people are viewing India as a good place to invest. It's helping us in getting more FDI as well, not only just portfolio investment. It's helping us to get, giving alternate sources of borrowing to the Indian investors, you know, the foreign people investing here, etc. But at the same time, as has been pointed out and as we all know, that all these advantages can be wiped away if there is a forex currency crisis.
Yes.
Or let's call it a currency crisis. There is no proof to the contrary that a huge amount of currency reserve can withstand against a major currency crisis.
Sure.
We have to be cognizant of that. We have also to be cognizant of the fact that we are paying a high amount to keep this reserve. Roughly, RBI has released some figures that in 2015-16, it earned 1.32% interest on the forex of what it was investing, which has come down to 0.8%. As against it, in order to so-called sterilization against the, whenever it buys dollars, it needs to release equal amount of liquidity in rupees, and it's been lending at those bonds, special bonds, it offers about 6%. So 0.8%, 6%, there is a cost to it.
Indeed.
But having said that, we are aware of it. We need to maintain a very fine balance, because there is no proof to say how much of import coverage is good.
Right.
How many months of it, whether it should be 6 or 16, etc. It comes more by way of experience and more by way of perceptions of Indian currency,
Indeed.
and those kind of
Indeed.
things.
Mr. Bhattacharya, an appreciating rupee also brings with it other kinds of problems, doesn't it? For instance, our exports aren't doing too well at all.
Yeah, absolutely, you are right. I mean, this is the price we are paying, that instead of, leveraging our reserves that are rising, I would rather like to see that some amount of debate and discussion takes place on the composition of these reserves. The composition of these reserves is quite worrying for precisely this reason that you mentioned, which is an appreciating rupee. Now, for the world, we have much of this money has come through the debt route. For example, this year, so far, we have got an inflow of around 1 lakh crore and largely into debt.
Yes.
Compared to 45,000 crore last year. Our borrowing, and for the debt market, the cap was $51 billion, and it is already exhausted to the tune of 99.2%. Now, today only, there is a talk about raising this limit so that more money can come in. Now, why more money is coming in? Simple reason is this, that if you invest in any debt paper, your return is around 6 to 7%, whereas this money which is coming from abroad would have earned them, in many markets, it will be even earning them negative interest. So my sense is that we need to really look deeper into the question on exchange rate policy, that why we have allowed our exchange rate policy to be operated in a way that our rupee against the RER, going by the RER, is actually appreciating, and therefore there is a tendency, there's a one-way risk which is helping the foreign investor into this debt market, which probably is not a good idea
the concern that you're raising was raised by a very senior SEBI functionary just about 10 days ago, who said we need to look at this very constructively. Right. What can be done?
And this exchange rate policy is not just going against the strength and the durability of our foreign exchange reserves and the quality of foreign exchange reserves. It is also affecting our Make in India policy, because after all, when you have an exchange rate policy where your rupee is getting stronger, actually the tradable import sector is become, you can import them easily. So the tradable import sector is facing kind of a competition which it did not face a competition, because it is getting the advantage of a stronger rupee, which means the imports can take place. So therefore, both from the manufacturing side as well as from the foreign exchange management side, this exchange rate policy, in my view, is causing some concern. And if the exchange rate policy is relaxed, my sense, and the Reserve Bank of India can actually moderate it in a certain way, my sense is that things would get better, and you will get better quality of foreign exchange reserves.
Sure. Let me go to SP Sharma now. How does the industry view all of this that's happening around it? Do you believe that it's good for the industry, or do you believe that some corrective measures need to be taken?
Yes, India is attracting a lot of money from the foreign markets, and we are happy that now we have $400 billion foreign exchange reserves. Firstly, I would like to mention that India is a supply constrained economy. We are always in the current account deficit, and now current account deficit is rising once again. Now current account deficit is 2.5% of GDP in the quarter first of FY18. So at this juncture, we need lot of forex reserves to meet up our demand, because our demand is always intact, and we import a lot from the foreign markets, and our export import ratio is also stagnated. We are only 0.7% of 70% of our imports, and that is stagnated during the last 4-5 years. We are not able to increase much our exports. That need our strong forex reserves in our kitty. So next is that global economy is still volatile, and global market conditions are not that much intact. In the coming years, we will not be able to increase much our export growth trajectory, because demand conditions may remain subdued. And third is geopolitical conditions are again rising, and there are a lot of risks to the global growth. So that's why reserves at this juncture are needed, and we look forward that these should be strengthened more, as these are lucrative at this juncture. But as we have to go a long way, because BRICS economies have lot of reserves, like Russia. Russia is at around, I believe, 32-33% of its forex reserves percent of GDP, and China is also 27% of its GDP. But we are still 17% of our GDP. So we have to go a long way to increase our forex reserves in the coming times. That will be a major strength for Indian economy, to attract more and more money from the foreign markets and to invest in India. That will make fruitful our Make in India program in the coming times.
Sure. China has been raised a couple of times on the discussion so far. I'm going to go to Ms. Kohli now. She brought up China first, and you said how China has been extremely successful in managing its forex wealth. Do you believe that that's a model that we can follow here in India?
Well, it's hard to, because there are significant differences between China and India. There are significant differences in terms of when they started liberalizing and the growth model itself. China followed an export-led growth, industrialization and growth model right from the 70s, and India is some way off. But the key difference, at least in this context, is that China relaxed its FDI rules. It managed to attract foreign direct investment into the exporting sectors, and therefore was able to generate substantial surpluses. And through the same mechanism, it was able to lift out millions of its unskilled surplus labor from agriculture into industry, and thereby achieve reduction in poverty. India, on the other hand, has been much slower in opening up and liberalizing foreign direct investment flows. Moreover, even after liberalization, the unfortunate part of Indian foreign direct investment story is that it has been unable to attract FDI into the exporting sectors. The other significant difference is that India also embarked upon opening its financial account, that is the capital account side, quite in parallel to trade liberalization, whereas China never kept its capital account quite tightly closed. It retained a lot of capital controls and still does. But at the same time, now that it has begun to rebalance in the last 7-8 years, it is gradually relaxing its capital controls and opening up its capital account. So there is a big difference there between China and India. Having said that, India should certainly, I agree with my co-panelists who have made this point about exchange rate policy, and that it is detrimental to exports. There is a need to take a hard look at exchange rate policy, not just from the perspective of exports, but an appreciating rupee, a rapidly appreciating rupee, as past experience has shown, always engenders and carries the seed of eventual macroeconomic instability. Now, how does that happen? It happens because the more your rupee appreciates, the more imports become cheaper. And over time, the trade deficit on a structural basis, that is the difference between merchandise exports and merchandise imports, has continuously expanded for more than a decade. And the more imports take place, the wider becomes your current account deficit. And the moment the portfolio capital inflows come to a sudden stop, there is a reversal. There is a large steep correction in the rupee. Okay, the foreign exchange reserves may help because, you know, every time there is a reversal and there is a column run on the rupee, then having so many substantial forex reserves enables the central bank to moderate the path of depreciation. But eventually this model is unsustainable. It happened in 11-12, it happened in 2013, and I'm afraid that no lessons have been learned, and since February the rupee is appreciating, despite the fact that it's not that the Reserve Bank has not purchased enough foreign currency, but in my view it ought to have purchased more, and I'm sure, having been bitten twice, you know, the Reserve Bank must be very shy, but there has been a loss of policy space. There have been a policy constraints imposed upon the central bank because of demonetization. It simply did not have, it had to sterilize so much of excess liquidity caused by the surge in deposits towards the banks because of the cancellation of currency, 86% of the currency notes, that it just did not have the tools, instruments and the bandwidth to sterilize as much as it would have liked to, perhaps.
Right.
Not only the forex reserves on the spot market, but even the forward book has been built up to the tune of about $17 billion.
Sure.
So, you know, and as we can see, the non-oil, non-gold imports from February till now have grown like on an average about close to 30% monthly.
Sure,
And
fair
on
enough.
the other hand, exports haven't sustained. There was a pickup in exports for about 3 months, like February to April, and after that, exports seem to be running out of steam.
Right.
And now the Federation
your point well
of
taken.
Indian
I'm going to take that
Export,
forward.
Organizers
I'm going to take that
is
forward with
saying
the other
that, look,
panelists as well, because we're running out of time right now. But, you know, a major currency management challenge then for the RBI going ahead, Mr. Dua?
Certainly, there is. The RBI would need to take a call on should its action of buying up dollars, just been said that it should have been buying much more than it has. Whether one, it can afford it in the context of the recent developments about its own balance sheet issues. Second is the issue of, just in case the fuel prices do not remain subdued the way they have since 2013-14. That's helped India a hell of a lot.
Yes.
Otherwise, our import bill would have been very much higher. The current account deficit would have been twice as much.
The last 2 months haven't been too good for us as far as the fuel is concerned.
Absolutely, a slight increase, but I'm saying had it gone up to the level of $100 plus, things would have been different. So it needs to be debated that in the Indian context, how much of import coverage should we be looking at in the context of, one, the global uncertainty about political uncertainty. We have much more than we've seen ever in the recent past, whether it is America relationships with Korea or the Gulf issues, those kind of things. Second, we have to be concerned about our export competitiveness. I emphasize that more than anything else, because if the moment we start losing markets, it's very difficult to enter them again. And a too strong a rupee is doing exactly that.
Sure.
We have to be cognizant of the fact that the rupee can be supported by the RBI only up to an extent. Beyond that, it should find its real value.
Fair enough. You know, Mr. Bhattacharya, trade deficit was mentioned a couple of times as well. Are you concerned about the widening trade deficit, or do you believe that that is something that will get corrected on its own?
No, I don't think it will get corrected on its own, because given the condition of the world trade, which as we all know is for the first time in many years is not growing as fast as the global GDP. So I don't think there is any relief coming from the export sector. Yes, the August figure shows a 10% growth, but that's to my mind is a blip, because it is not a sustainable growth. So, and given the fact that exports are not going to bail you out, but imports, both on account of gold as well as your other commodities, even the oil prices are rising. So I see trade deficit widening further. And in this kind of a situation, what is happening is that not having a policy with regard to the kind of inflows that you want to have is probably a bit risky and harmful. Just to want to give you a set of data,
Yes.
you know, in 2014, 13-14, our debt service payments as a ratio of our current receipts was around 6%. Today it is 8%. So it is inching up. It has not yet become an alarming figure, but it is inching up. So therefore, I would say that the government as well as the RBI should take a close look at what kind of policy it wants to have on external commercial borrowing by Indian companies, and two, what kind of debt inflows should be allowed into corporate bonds and even on government papers.
Sure. What corrective measures should be taken then going ahead, Mr. Sharma?
Firstly, I would like to mention that rupee appreciation or depreciation is not related to the export growth, because when rupee was appreciating in 2004, 5, 6, 7, our export growth was more than 20%, sometimes even more than 25% and even 30%. So these are the global demand conditions which impact the export growth. So at this juncture, I would like to mention that if rupee is appreciating, that is good for the economy, because our import content is also high in our exports, in our re-exports. Going forward, we suggest that there must be more focus on the policy reforms at the domestic level to attract more and more investments from the foreign market, because these investments are ultimately going to benefit the Indian economy, to generate employment opportunities and to boost our already announced policies, lucrative policies, which will provide fruit at the ground level.
Okay.
So we look forward for the policy environment to continue and to attract more and more capital from the foreign markets.
Okay, fair enough. You know, I've got about 2 minutes left on the program, so I'm going to try and accommodate as many comments as I possibly can. Renu Kohli, you know, are we concentrating too much on foreign investment? What about the domestic investment?
Well, that hasn't revived, and it's extremely worrisome that the shortfall in investment, which started from 2012-13, is continuing despite the positive terms of trade impulses, despite significant amount of reforms, and despite easier monetary policy. So we need to take a hard look at that.
Sure, fair enough. Mr. Dua, you know, as far as the economy is concerned, would you say that the worst is over, or you think that it's still going through a lean phase?
I'm keeping my fingers crossed. We hope that what we thought was an excellent monsoon, we'll have good agricultural output. Now the data coming in of late shows that the August rains were not good. The crop actually might be lower, the output might be lower than in the previous year. So that affects aggregate demand, an issue which is extremely important for cycle of investment to be revived.
Sure.
If the domestic demand doesn't build up, and our economy, as we know is far more, investment is far more domestic driven than overall. So I'm keeping my fingers crossed.
Okay, fingers crossed as far as you are concerned. But there's been a stagnation in the computer services exports. Now, is that a major concern? Because that's where our jobs really come from, Mr. Bhattacharya. That's where the young educated youth get their jobs from.
Yeah, absolutely. I think there is a problem in that area. You're talking about the information technology services. There's the global situation is also not very conducive to higher growth. The markets in the US is not looking very bright. So therefore, within the country, we have to look at sectors that are creating jobs where jobs are needed more. So I think there is no doubt that we are entering a phase of slowdown.
Right.
There is no doubt that both demonetization and GST will have have created a situation where the India Inc. is still not confident of reviving investment, because investment rate is still very low at 29%. So if we are comfortable with the growth rate of 6 to 7%, we may still reach that level. But can this country afford a growth rate of 6 to 7%? I don't think so. If we want to aim at 8% plus growth rate, which is necessary for a country of India's size, potential and demands, I think we need to look at deeper reforms, factor market reforms, and most importantly, revival in the industry's sentiment in the government. The animal spirits are completely gone, in my view.
Sure, fine. Fair enough. On that note, then I'll have to call it a wrap on this edition of The Big Picture. I'd like to thank all my guests, Renu Kohli, Ajay Dua, A.K. Bhattacharya and S.P. Sharma for joining me on the program and putting things into perspective for us. That's all the time we have today. See you again next time.